All right, so for those of you who just came in, okay, hi, my name is Bowen, and I will be the one that will be going through this fundamental investing with all of you. Right, so as what I've mentioned earlier on, we will be starting at 8:35. Right, so if you are just in, okay, just let me know that you are able to hear me loud and clear by typing a 133 inside the chat box. All right, so just do me a favor, type in 133 if you are able to hear me loud and clear inside the chat box. And I see quite a number of your reply already from Irene, Andrew, Felice, Thomas, Linda, Ed, Kelvin, Lay, Carol, Lai as well. All right, thanks for typing in. So while we are getting started in about 1 minute, okay, yeah, let's just have some nice music lah. Although I know that this music together with the weather is a little bit a little bit sleepy. Yeah, even for me when I listen to this music, I feel like sleeping. Okay, let me just hype out the music a little bit. Right, maybe it's the wrong music for the wrong day lah, for the wrong weather. Okay, let me just stop. All right, I think you guys are better off listening to my voice without the music. Okay, so we will be starting in about 1 more minute, okay? But before I start, okay, can I just have a quick check? How many of you actually listened to the Fundamental Investing Series 2 before? Okay, that means I think 2 weeks ago you actually attended. Let me just check. Is it 2 weeks ago? If you have attended, can you just type in 555? Yes, that's right. 2 weeks ago on the 27th of December, if you attended the same one, can you just type in 555 into the chat box? Okay, from Thomas. Thomas have attended before, and Kelvin as well, Lay as well. So I assume Linda as well, Sam as well. Okay, so quite a number of you. So we have about 76 of you here with us. So about 10% to 50, about 10%. 10 to 15% of you have already attended before. All right, so let me just share with all of you how this fundamental investing series is being conducted. All right, so what happened is that every 2 weeks, okay, I would actually change the content. Right, so you realize that a month ago, if you have attended our fundamental investing, that is series 1, okay, whereby I share more about, what is the economic mode, what is value investing, and then for the series 2, I touch on a little bit more on the valuation portion. Okay, so that is series 2. So I just want to let upfront tell you all that, okay, 2 weeks ago, the content and this week will be pretty much the same. Okay, but of course, you will be, you are welcome to always stay on and listen again, okay, as a refresher, right? So of course, if you have already attended today's, right, so do look forward to the next one, which is 2 weeks later, okay, because for the series 3, later on, I'm going to share with you what I'm going to share for series 3, but it is going to be very, very exciting, right? So I think we are going to get started right now. The time now is already 8:36. So as promised, okay, we will actually end this at 10 p.m. sharp lah. Okay, according to what I did 2 weeks ago, I tend to overrun because the topic that I have for today is a little bit more intensive, right? So that is why I do hope to get you guys to actually bear with me if I go a little bit faster this week, right? Because what happened is that I want you guys to actually do the practical, okay, towards the last 10 to 15 minutes. That is where you actually get to learn more. Right, so as a start, I just want to say thank you to all of you who have actually left a Seedly review. I have also posted this on the Telegram as well. So if your name is actually on over there, okay, Yikai, Maureen, May, Patricia, Phyllis, one of them, okay, please do collect this physical book, okay, by Ivan Low, okay, at this particular cafe called Two Blur Guys at 387 Jalan Besar. And not only that, while you collect your free books, at the same time, you get to enjoy a free coffee, okay, or a small snacks from us that is worth $5. All right, so again, once again, thank you so much for your Seedly review. So I just want to do a quick introduction about who am I and of course where I come from. So I'm one of the co-founder of Ultimate Investing. So in UI, we have 3 different co-founders. So on the left-hand side, the very handsome guy is Paul. So Paul is actually the FA guy, the fundamental investing guy in the Ultimate Investing. And for myself, I actually do more on options. Right, so moving forward, I think if you are inside our Telegram, you probably get to hear more from me when it comes to options, right? And of course, in the middle, we have Ivan. So Ivan is actually the technical analysis guy. So if you love charting, you love looking at charts and all that, okay, so you know who is the person to talk to lah. So of course, for today, I am going to actually share with you what Paul has shared with me, okay, because Paul is the FA guy. So he's the expert, but today I'm going to be the one that is going to share with you more about fundamental investing. So for the next 1.5 hours, okay, we're going to do this thing called accelerated learning. So what do I mean by accelerated learning? Number one, our energy is going to be high. All right. So if you can see, I try to be as high as possible. Right. And of course, I need you guys to participate 100%. So how are you guys going to participate 100%? Very simple. I'm going to ask you guys to type something, okay, inside the chat box. All I need you guys to do is to type in as fast as possible. All right. And of course, while you're typing, you get to remember. And at the same time, you get to stay awake. So can I invite everybody right now to type in 100% into the chat box right now? 100% as fast as possible. All right, fantastic. Okay, I'll be able to see all of your response, okay, on my left-hand side. So thanks for participating, and you guys are really fast. Right. So the third thing that I'm going to do is more on repetition. So when there is anything that is important, I will actually pause. I will repeat the same thing again, okay, because I want you guys to be able to remember it. And last but not least, this 1.5 hours is going to be both visual as well as kinesthetic. So visual basically means that I'm going to use as much example as possible, as many pictures as possible for you to remember. So it's not going to be just me talking a lot. You are also required to actually look at the PowerPoint and get to see as well. And what is kinesthetic? Kinesthetic basically means that you get to learn by doing it. Okay, so that is why at the last 10 to 15 minutes, I've actually allocated timing for you guys to actually do the research, so that when you do the research, you get to learn a lot more. For those of you who have experienced it during the series 1, you will understand that this is very, very powerful. Right, so right now what we're going to do is going to do a quick revision for the series 1. So for those of you who missed the series 1, don't worry, I'm still going to go through exactly what I've went through a month ago. So first question over here, what is on the stock market? A, all about charts. B, gambling den. C, real business. Can you type in the answer? A, B, or C? Okay, so most of you put C. Okay, fantastic. So C is the correct answer. So the stock market is all about investing in real businesses. All right, so it's not 100% about chart. It is not a gambling den. But basically today when we invest in the stock market, we are looking at real businesses. For example, companies like McDonald's, companies like KFC, Pepsi Cola, all these are real businesses that we are familiar with. So the second question, okay, what is value investing all about? So I have two questions over here. We want to buy something, and we want to buy them at something. Can you all just type in for those of you who still remember? What is the forward over here? Anyone still remember? Okay, yes, we want to buy good businesses. That's the correct one. And we want to buy them at what? What is SP? We want to buy good business and we want to buy them at SIC price. That's really close. Special price? No, very, very close. Very, very close. Okay, let me just share with you the answer. We want to buy good businesses and we want to buy them at a sensible price. Okay, but you guys are not wrong. We want to buy them at a SIC price. We want to buy them at a special price. All right, but in short, we want to buy them at a sensible price. Something that actually makes sense. Right. So you realize that when it comes to investing, it is actually not as complicated as what a lot of people tends to be. It's like, you have to be able to look at the economic, you have to be able to look at, the weather, you have to look at what people are doing, whether are there war, is there any political issue, yes, those are important things that you need to take note. But end of the day, you realize that if you are investing in a good company, okay, over the long run, as the company makes more and more money, what happened to the share price? The share price will also grow in value, right? So just think of, some of the blue chip companies in Singapore, for example, if you bought into DBS, OCBC, UOB 10, 20 years ago, every year they are making money. What happened? The share price naturally, it will go up. And if you look at a business that is not doing well, for example, High Flux, okay, some of you might not be familiar, but High Flux over the last few years, they are losing money, right? So if you're investing in a company like that, naturally, it will go bankrupt. All right, so that is basically how business actually works. So always remember, okay, why people actually lose money. Number one is because they have no proper system of evaluating and investing in shares. As a result, okay, we tend to buy into bad companies basing on their decision on hearsay. What do I mean by bad companies? Okay, later you will get to understand that when we look at companies, the most fundamental thing that we want to look at is first, the company must make profit. Okay, So for example, today, if let's say your friend say, hey, I have a business and I want you to put more money. The first thing you will ask is your business making money or not? Okay, can you imagine if let's say your friend say, hey, I have this business, every year lose money one, and I want you to invest in this business. Will you invest in it? Okay, probably not, right? Unless your friend actually share with you that, hey, but because I have a plan to turn this business around and I feel that this business has the potential over the next 2 years, I'm going to turn it into profit and it is going to make a lot of money, right? But again, you realize that comparing a business that is already doing well with a track record and the second company that is losing money but has the potential to turn around and make money, which one will you prefer, the first one or the second one? First one is already every year make money consistently, then want to sell you the business. Second one is lose money but has the potential to make a lot of money. One or two, which one will you prefer? Right, I would say that most of us would actually choose number one, okay? And of course, some of you would choose number two because you want to be able to turn your $1 into $10,000 or $100,000. But if you want to be able to sleep well at night, okay, you want to look for something with consistency and track record. All right, I think that is very, very important, okay? Especially when we look at the stock market right now, we have Bitcoin, at almost $40,000, and we have company like Tesla at almost $800. So we have a lot of all this company that has shot up quite a lot. Okay, so a lot of people is like, well, in fact, some of my friend has been telling me is that, hey, Bowen, do you know that, right? Based on the last half a year, okay, last 6 months, I don't even need to learn how to invest there. I just throw a stone at any stock, all will make money one because everything is going up. Technically, it is true. Okay, so I would say that right now the market is very, very bullish. So if you are making money, congratulations, because you are riding on the right trend because the market is going up. But okay, if you want to continue to make money in the stock market, I think that is where a lot of people have to learn. All right, when to take profit, and of course, finding the right company to actually invest over the long run, which we will actually share more subsequently as well. So the second one is people tend to overpay even if the companies are good, right? And that is where we are talking about blue chip company. For example, people talk about, REITs. I'm not saying that REITs are not good, but let's say before this crisis happened, you realize that most of the time REITs tends to be a little bit more expensive. All right, so sometimes there will be certain correction, so people realize that, hey, actually this stock is a little bit expensive, then the price will drop. Right, but of course, if you look at the market right now, expensive will become even more expensive. All right, everything just go higher and higher and higher. Nobody care whether this thing is undervalued or overvalued. As long as they love the company, everything will just keep going higher and higher. And of course, the third one is people tend to take profit too early in the stock market. Okay, so just talking about this particular point, I just want to ask the 87 of you over here. How many of you, right, have actually sold a stock too early? Okay, that means if you have actually hold a stock until today, you would have made a lot more one. Okay, can you just type in 888? Type in 888. All right, Irene. So Alex as well. Let's also see what about the rest of you. All right, I know some of you will be referring to Bitcoin. Maybe you bought Bitcoin at $300 or you sold it at $300. Right now is $40,000. So yeah, a bit sad. All right, 888, totally unhwatted. All right, so if you all don't mind, okay, Irene, Alex, Linda, Dwayne, and David, can you also share with us what company is that? If you don't mind, can you also type in what company is that? It can also be Bitcoin, if let's say you really sold off Bitcoin at a very, very early price. Okay, Roku. Okay, interesting company, Roku. Qualcomm, DB. DB, I'm not sure is it Deutsche Bank. Okay, but yeah, DB is Deutsche Bank. Oh, DBS. Okay, DBS. Roku, DBS, Qualcomm, and what else? What else? Any more? Or only these three? Right, so that is why when it comes to investing, right, you realize that as long as this company continue to make profit for you, technically you shouldn't sell it away. All right. But of course, there will be times where the stock is so expensive or so overvalued that you might want to actually take some profit out, okay, and then reinvest it into some other place. All right, Tesla as well. Yes, exactly. I know how you feel. right? And coming to the last point is that some of us, we do not have inbuilt system of safety. What do I mean by this? All right. I know some of you might have invested in, for example, Tesla, or you might have invested in some of the tech stocks, and you're making a lot of money. So what happens is that you tend to put all your money into all the tech stocks. All right. So of course, right now, if everything is going up, especially the tech sector, you can make a lot of money. But what happens if, let's say, there is what we call a sector rotation? So the tech stock starts to come down, other markets starts to go up. If all your money is inside tech stocks, then you realize that, hey, it might be a little bit risky for you, and you might lose a lot of money if you're overly concentrated into one particular sector, right? So as much as possible, especially if you're new to investing, I would encourage everybody to diversify a little bit, all right, so that you can actually spread your risk, right? So remember, there's actually a proper way to profit from the stock market. So 3 key investing principles that I have. The first one, I'm going to share with you the answer, and that is diversification. Okay, so can I invite everybody to just type into the group chat so that you can remember this? The first one is diversification. All right, so yeah, just help me by typing into the group chat, diversification. The second one is cut your losers. Okay, cut your losers. So if let's say you have a stock that is losing money, okay, first thing you need to understand is, why is the stock losing money? Is it because the fundamental has changed? Is it because the company has got bad news? Okay, find out why. Okay, and if let's say this company has been dropping years after years, has been dropping, and what happened is that inside your mind, you are just hoping that the stock will recover one day. Okay, but many times you realize that the stock doesn't recover. It just go lower and lower and lower and lower. All right, so always make sure, if the company for no reason actually keep on dropping, there is always a reason. Most likely it's the business fundamental have changed. All right, so if need to, cut your losers. And the third point is to let your profit run. Okay, if you're making money, please don't be so itchy finger, go and take profit lah. Okay, because you realize that most of the money that you make, right, from the stock market is actually made not by investing, but rather by not doing anything, buying and just waiting. Okay, because the price naturally, for example, people who have been invested in Tesla, you realize that they just buy and then just leave it there. They don't have to do anything, and right now they'll be sitting on a huge profit. Right, for those people who have been buying and selling, buying and selling, buying and selling, you realize that they tend to be not making that much. Okay, so let your profit run is also something that is very, very important. So we're going to look at, when it comes to investing in good company, there's 2 areas. One is what we call qualitative. The other one is called quantitative. So let me share with you over here, the first one, which is qualitative. We look at the management, we look at the company culture, we look at the competitive advantage, and we look at this thing called branding. So qualitative are basically things that is hard for you to measure. So for example, I say that, some people say that Elon Musk is good, the management of Tesla is good, but how do you measure that? You realize that it's hard to measure, right? There are also people who say that, Elon Musk is crazy one, expect me to work 20 hours a day, expect me to hit 500,000 car in a year, etc., etc. So different people have different ways of looking at the management. But there are people who say that, yeah, I'm looking at a management that is efficient, that is able to adapt to changes. So for example, in March this year, we had, March last year, we had the arrival of COVID-19. So a lot of business are actually affected. But you realize that, for example, we just look at the retail sector alone. Okay, retail sector alone. There are many retail business that actually went bankrupt. But yet at the same time, there are some retail business that actually did even better after COVID. What is the thing that they have changed? They actually turned their whole business model from a retail brick and mortar business. They changed everything online. So when they change everything online, you realize that they actually cut off this thing called the middleman. So in the past, they have to supply to the middleman, and the middleman would actually sell all their products to all the different consumer. But because of COVID, they realized that, hey, I can't open my shop. I can't give my product to the middleman. Why not I create a website and I spend more money, I spend more effort making my website more nicer, and of course the whole supply chain even smoother, right? And that is where they realize that, hey, actually by doing that, they get to cut off the middleman, and the sales actually increase because now the profit margin is even higher. So one of the example is this company called Walmart, right? So Walmart is already one of the largest supermarket in the US, but what happened is that ever since COVID, they actually spend a lot more on, online And they realized that actually the profit actually went up quite significantly, right? And of course, we look at our favorite brand like Nike and Adidas, all right? Realize that nowadays they are doing a lot of sales online directly as well. They are dealing directly with the customer. So these are some of the things that we want to look at in terms of the management. So the quantitative are basically things that we can measure, things that have a number to it. So number one is, of course, earnings. Okay, is the company making money? Secondly, is the cash flow. Is the money going into the bank account or not? All right, and of course, the third one is the efficiency of the business. How efficient is the management in utilizing the capital of the business? Right, and of course, the last one is the debt. Does this company has got a lot of debt or very, very little debt? So these are things that we can actually put a number to it, which makes it easier for us to analyze. Right. So later on, you realize that when it comes to looking at the business, the qualitative part is a little bit subjective. So some people can say that, hey, I think this management is good. The other guy can say, yeah, I think this management is not good. So it's very subjective. There's no right or wrong. But when you look at quantitative, looking at the numbers, it is a lot more straightforward. All right. So for today, all right, and for the FA series, we're going to focus more on the quantitative portion. Okay, looking at some of the patterns and some of the trends, okay, to determine whether this is a good or this is a bad company. And of course, number 5 is understanding business mode. All right, so mode, I'm not going to share too much, okay, but basically when you look at the mode itself, there's actually 3 different kind of modes. So starting with the first one, and that is network effect. So what is a mode? A mode is basically an advantage that the business actually have. All right, so for example, we look at this particular mode called network effect. So one of the examples I can give you is, for example, we look at, Alibaba. So Alibaba is basically a platform that links the buyer and the seller. So if today you want to sell something, you go to Alibaba, put your product there, and the buyer, you want to buy something, you go to Alibaba and you go and buy your product there. So they are what? They are just the middleman. So if you look at Airbnb, Airbnb does not own any property, but they are again the middleman between the property owner, okay, who want to actually rent out their room, okay, and also people who want to rent room. All right, so they are just the middleman. So most of the network effect, those business actually are what we call platform businesses. Okay, platform businesses. They are just a platform for people to actually jump in. So why does a platform business has got this thing called the network effect? It's because, okay, you realize that at the start, right, of a platform business, it is difficult for them to establish the branding. All right, for example, when Facebook first started. So right now, if let's say we move back 10, 15 years ago when Facebook just started, will you use Facebook? Probably not, right? Because why? Nobody's using Facebook, right? But slowly and slowly, you realize that when more and more people are using Facebook, all your friends, okay, maybe 20% of your friends or 30% of your friends start using Facebook, then you start to jump into the trend as well. Okay, then more and more people jump in. So when more people jump in, you realize what happened. This platform becomes more and more powerful. All right. So of course, when there's more people jumping into Facebook, what happens is that as a business owner, they also want to advertise over there. All right. So you realize that this thing just built stronger and stronger. So right now, today, if let's say I give you $10 billion, okay, I say that can you create a platform to replace Facebook with $10 billion? If you think it is doable, that means this company has got no moat. If you think it is difficult because they are already so strong that 10 billion, you can't really do anything to destroy them, then yes, they have a very, very strong moat. All right, so just think of it in this way. Today, I want you to come up with a soft drink to destroy Coca-Cola. Is it easy or not? You realize they're not that easy, okay? Yeah, you can call yourself maybe Pepsi Tea, or I don't know, Pepsi Kopi. Yeah, but nobody will do that. People will still go for Pepsi Cola or Coca-Cola, right? Because of the branding, right? Of course, the next one is intangible asset, and that's where we talk about this thing called branding, as well as those patents. Right, so of course we look at some of the brands like Louis Vuitton or Hermes. Why are they able to charge so expensive? It's because of the branding, right? So same thing. Why is the branding so powerful? It's because today, if you are a competitor, it is not easy for you to kick them out, because today you can come up with the same handbag, made out of the same quality, but without that logo, you realize that you can't charge as high as what they charge. True? All right, same thing for a car. You realize that today you can come up with a car that looks exactly like Lamborghini, okay, but without the Lamborghini logo, you can put a Honda logo over there. You realize that the price of the car maybe dropped by 50%, right? Just because of the branding, it is not there. All right, so same thing, the branding, it is not powerful on its own, but if your brand is able to protect your brand, then yes, you have got this thing called economic moat. Right, and of course, the last one, okay, what kind of business do we want to invest in? Just now we talked about platform business, okay, and the second one is, of course, the branding. The third one is basically business that has this thing called switching costs. Okay, what do I mean by switching costs? Switching costs basically means that the moment the customer use your product, right, it is very difficult for them to switch to your competitor. Right, just to give you an example, how many of you have been using Microsoft product on Microsoft Word, Microsoft Excel? If you're using Microsoft, can you just type in MMM, triple M? Microsoft Word, Microsoft Excel, Microsoft PowerPoint, Microsoft Outlook, anything lah. Right, so you realize that, right, in the market itself, Microsoft is not just the only one that comes out with all this PowerPoint and Excel and all that, right? You realize Google Sheet also can do the same thing. All right, and of course, for example, if you're using a Mac, you can also use a Keynote to do pretty much the same thing. But why? But most of us are still familiar with Microsoft, because even when I'm using a Mac, I still go and download the Microsoft PowerPoint that is compatible for Mac. Okay, I don't really use the Mac Keynote. I don't really use some of the other software, because why? I'm actually so sticky to the Microsoft PowerPoint, right? So that is where this business can be very, very powerful, because people don't really change to another company. So what are some of the other companies that falls under this is, of course, software as a service. So of course, we can talk about our handphone, which is Apple versus Android. So if you're an Apple user, for example, you have the iPad, you have your Apple Watch, you have your MacBook. Okay, you realize all your ecosystem is under iTunes. All right. So it is very difficult for you to actually switch to Android, because the moment you switch, you realize that the whole account, all the system in the cloud, you have to find ways to convert. Maybe there is ways, but it's just so difficult that you don't really want to use your brain juice to think of how to convert them from Apple to Android. But you realize one thing, it works the same way. If you're so used to using Android, you do not really want to change it to Apple as well. So there's always pros and cons. Okay, people cannot switch out. People also find it hard to switch in. Right? And of course, for Salesforce, Adobe, and etc., you know, most of the software, when they actually create this software, right, they try to make it difficult for people to switch out. That is part of the feature of the product itself. Right? So the next part we want to look at is breaking down the financial. So previously we talked about when we look at the business, there's four main pillars that we want to look at. Number one is the earnings. The second one is cash flow. The third one is efficiency. And the last one is debt. All right, so I hope you all still remember what are the four. But basically, this is the overall summary that I have done up for the series one itself. So very quickly, in 5 minutes, I'm just going to go through this. So when it comes to earnings, we look at earnings per share. It has to be positive and growing. Okay, it makes sense, right? Today we invest in the business. The business must be making money, and preferably every year they are making more and more money. The second one, the cash flow. Okay, looking at the bank account. Okay, because why? Today I can say that I make 20,000 a month. Okay, let's say I'm a real human. Okay, I'm a working adult. I say that, hey, 1 month I make $20,000. But then you go and check my bank account. Hey, how come every month the money doesn't go into the bank account? What happened? Because I spend the money. Okay, right. So in terms of the business itself, do you think it's healthy or not? I can say that I make $50 a month, $100 a month, $100,000 a month. But if you look at the bank account, money doesn't flow in. Either I spend everything away, or, okay, in certain business, right, they find it difficult to collect the money from the customers. So what happens is that every time they secure a deal, they already lock in the profit. On paper, they say, I already make 20,000 sales. But what happens is that when it comes to collecting the money, they have difficulty collecting the money. So what happens is that on the cash flow side, it will appear as negative, right? So we want to make sure to be safe that the cash flow, operating cash flow, is always positive. That's also something that we want to look at. The third one is efficiency. Okay, ROE. ROE to be more than 15%. All right, and of course, the last one is debt to equity, which is looking at the debt to be less than 0.5. So these are the four things that we look at. All right, so for today, this is going to be the key topic for today. Okay, I use about 30 minutes already. Right, the intrinsic value of a business. How do we know what is the real value of the business? Right, so I'm going to use this as an example. What is the real value of this watch? Can you type in? What do you think is the real value of this watch? Assuming that it is a real Rolex, Oyster Perpetual, Daytona. Can you just type in? How much do you think this watch is worth? A brand new Rolex Daytona. Come on. Just type in into the group chat. Let me see your answer. 13K from Dwayne. Okay, 13K. What about the rest? 20,000 from Fong and Irene. 25K. Simon, 5K. Wow, not bad. So you realize that there's already a range. Some people feel that this is worth 13K. Some feel that it's 30K. Some feel that it's only 5K. Wendy is retail 16K. Wow, Wendy must be a Rolex supporter. Okay, a lot of Rolex ones. So look at retail price. All right, but anyway, let me just share with you some of your answer. For example, some of you might say that, this is $500. Some of you might feel that this is 2,005. Some say this is 10K. Some say this is 25K. So up to you to determine the value. But over here, how I determine the value of this particular watch, I go to this website called Carousel. Okay, and then this is what I find. This is what I found. I found this guy selling at $39,999, and then I check another seller. Okay, another seller is selling at $38,500, and I check another one. Okay, I don't just check one. I check three. The third one actually want to sell at $37,800. So based on the little research that I have done, okay, if let's say today, right, you get to own this brand new Daytona at a price of $25,000. How many of you would like to buy that? If you would like to, just put a Y. If you don't want to buy, put N. Yes for Y, N for no. Based on my research, okay, again, I'm not trying, I didn't put in fake info. Really, what I find, I just put it in. All right, 30, 39, 40K, 38K, 37K on Carousel. You can go and check it out. Maybe you can find the same name. All right, but pretty much I see based on your answer, most of you are happy to pay for it, right? Why? Because you know that the value of this, right, is easily, okay, I wouldn't say the guarantee at 38,000, but easily above $35,000. So if let's say today you get to actually own this at $25,000, technically you know that you're buying something that is worth value at 35,000, but you get to buy it under value. All right, get to buy it under value. All right, so this is exactly what we want to do over here. Okay, this is exactly what we want to do over here. We want to buy under value businesses. All right, but the difficult part about this is that, right, okay, how do you know how much is a business worth? I think that is always the challenge. Because for example, for these watches, I go to Carousel. Okay, so Carousel is one of the way for me to know the value of this particular watch, or at least the market value of this particular watch, right? But when it comes to businesses, it's not exactly that simple, right? So this is what Warren Buffett mentioned: a price is what you pay, value is what you get. Okay, so never look at the price itself, okay? Never look at the price. So there's actually three ways to evaluate a business. Number one is look at the book value. Okay, that means looking at the net worth of the business. So if let's say today the net worth of the business is $10, you want to buy it below $10, below the net worth, okay, or rather we call it below the book value. The second method is looking at the earnings. Okay, there's this thing called earnings multiplier. Later we're going to touch more on that, but basically first one is looking at the book value, second one is looking at the earnings, and the third one is basically to look at the dividend yield that it is giving you. All right, so three methods: book value, earnings, and dividend. So people ask, so Bowen, why are there different valuation methods? Why can't we use one single method to evaluate all the business out there? Okay, very simple. I'm going to give you this particular case study. So for example, right now I have, let's say all of us, we have a daughter. So our daughter has got this boyfriend A. So boyfriend A is an undergraduate, no income, currently studying at Harvard University. This is the boyfriend. Okay, the boyfriend has got no income. The boyfriend is currently studying at Harvard University, no house, no car, got 5,000 savings. Right. So do you think this is a good boyfriend or not? Yes or no? Looking at the information. If let's say this is your daughter, will you say yes to let your daughter go and date this guy, or you will say no? Okay, Irene say yes. Irene say yes. Okay, David say potential. Yes, okay, interesting. And what about the rest? Like Tesla potential. Right. Yes. Okay, so Alex also put yes. Okay. So if I never show you all this, right, maybe Okay, like maybe some of you put yes like because of Harvard, right? Okay, but you realize this, what kind of company is this, right? This is what we call a startup company. All right. So when we are when we are looking at a startup company, you realize that they do not have the track record that you are looking at. Okay, they have no earnings, they have no cash flow, everything seems to be lousy. But if you know that, for example, this one, what's the keyword over here? The keyword is Harvard University. Right. So you know the people coming out from Harvard, their basic pay is easily 10K and above. Right. So there is a potential over here. Right. So based on this potential, you might actually invest in it and give it a higher valuation instead of the normal valuation. And of course, we have the second guy, okay, the second boyfriend. Okay, so boyfriend B is a young executive with stable income of $4,000 every single month, is a university graduate, no house, no car, but got $50,000 in saving. And not only that, his income is growing annually at a rate of 20%. Okay, good or no good? Good or no good? Again, if your daughter want to have this boyfriend, good or no good? Like DBS, okay. Okay, that's a good example. Okay, like DBS. I'm not sure if DBS is growing 20% a year. Yeah, I think this is better than DBS. All right, good. All right, I think all of you don't mind. I also don't mind. Okay, you got a girlfriend, every year make 20%. Okay, this is what we call an earnings company. And also something with a track record. Okay, and at the same time, you know that the growth is quite stable. Right, so most of the companies, okay, in fact, this is the kind of company that we would prefer to invest. Like if you want to be able to sleep well at night, right? Okay, try to look for this kind of company with a good track record. Then every year growing at 10-20%. Won't one. Okay, stable one. This is the kind of company that if you invest in it, if you buy at the right price, you can sleep well, sleep very well at night. And of course, we have the last one. Okay, this is what I call the bond rich kind. Okay. This boyfriend is a cashier working at a land shop, making 1,500 every single month. Polytechnic graduate, but he has one condo fully paid, one car fully paid, $400,000 in saving. So his income, no potential one, but so zero growth, but very stable stable income is zero growth. So good or not good? Well, this is the very interesting one. Just want to hear from you guys. Okay, Irene, no good. Why? Alex also saying no good. Seriously, y'all don't like people who have a lot, who are asset rich. Like read, okay lah. Exactly what? Exactly. This is exactly like read, right? Asset rich, asset rich. Good for short term. No fighting spirit. I think y'all are putting it very personally. Right. But you realize that, okay, it's just how this business is actually growing. For example, if you look at a lot of company in Singapore, it is already matured. Okay, already matured. Okay, that means, right, they have already expanded beyond Singapore, already maxed out already. There's no way they can actually continue to grow. So this is a kind of company that they have a lot of money. So the earnings is stable one, nothing exciting, but they have a lot of asset. Okay, so once again, right, okay, over here, I'm not saying that this is good or not good, but rather if you look at this, right, the way to analyze this company is going to be different from boyfriend A, is going to be different from boyfriend B. Okay, so 3 different companies, 3 different kind of guy, you realize that you have to use different method to actually look at them. All right, so once again, I'm not saying that A is better than B or B is better than C, okay? They are just totally different kind of business. So startup company is basically company with no track record, but they have a high potential. All right, and of course, this is something that I think in the stock market right now, a lot of people is very, very bullish in this group of company. All right, basically companies that just gotten IPO, companies has got the potential to make a lot of money, but most of them, you realize that they are not making money. Most of the company are losing money. All right, and of course, there are also people who love to invest in earnings company, the track record of earnings. So if you look at, for example, our guest speaker for the UI Day, Dr. David Koh, I would say that his preferred kind of company to invest is the second kind, companies that are very stable. Companies that has been making money for the last 20, 30 years, in fact, even better, the last 50 years, and they have been giving dividend every single year. This is the kind of company that he would love to invest, buy, leave it there. And of course, you have the last one, which is the asset rich. So these are companies that already reached the maximum growth. Okay, so the earnings is stable. All right, but they have a lot of assets, right? And most of the time, because they make money, so they actually distribute consistent dividend as well, right? So sometimes they do give out the consistent dividends. So if you look at these 5 companies, right? Okay, so just to do a very simple exercise over here, can you all let me know, looking at the first one, C, okay, which is the company that Shopee actually belongs to, can you let me know which one it actually belongs to? Startup, earnings, or asset rich? You can type in the first letter, SU, EC, or AR. What do you think? C, the first one. All right. So most of you actually put startup. Okay, fantastic. Okay, that's great. That's great. And we look at the second one, Singtel. Singtel is startup, earnings, or asset rich? This one is a little bit vague. I know some of you will put earnings, some of you will put asset rich. Okay, but I will just put it as earnings company. Okay, earnings company, because they are still in a way, technically, right? Okay, if you look at Singtel, they are actually still growing. Okay, overseas. I know locally, right, they are not much growing because they pretty much dominate the whole market really. And in fact, Singapore market is being diminishing. Okay, that means competitors are coming in. But if you look at the whole business of Singtel, I would say that I think only 30% is in Singapore. The rest is actually overseas. So they do actually have quite a lot of growth or growth potential overseas. Right. And of course, for Capital Mall, this is definitely more of an asset rich. They have a lot of buildings. And OCBC, in short, banks most of the banks are what we call asset rich because they have a lot of cash. They have a lot of even if you look at the loans itself, right? Loans are considered cash as well, right? Last but not least, sets. Okay, what do you think? Sets belong to what? Startup, earnings, or asset rich? All right. Alex put asset rich. And what about the rest? What do you think about sets? Sets is basically the company that do all your logistic for the airport. All right. So your luggage, your food, your flight, all the food and everything. Even all the working personnel inside the airport, most of them are actually handled by sets. Right, so some of you put EC. Yeah, so I will consider this as a EC as well. So in short, right, you realize what are some of the companies that belong to asset rich? Usually those are companies like developer. They have a lot of buildings, or banks itself. They have a lot of cash, right? So pretty much, okay, asset rich are basically a company with a lot of asset. Pretty straightforward. Right, the rest of them, I try to put it under earnings company, especially those with a certain track record. So starting with the first one, okay, let's look at the one that most of the business actually belongs to, earnings company. So how much, okay, is this company worth? Okay, I'm going to use this as an example. So for example, if let's say today this 7-Eleven is for sale, okay, and the owner of this 7-Eleven is telling you that this 7-Eleven has a track record of making 200,000 net profit every single year. All right. How much are you willing to pay for it? Can you all just type it into the group chat? This 7-Eleven every single year has a track record of making $200,000. If the owner today is selling away this 7-Eleven and you happen to have the chance to buy, how much will you be willing to pay to buy over the 7-Eleven? What is a decent price that you're willing to offer? Can you just type in? What's a decent price? Okay, let's be realistic. Okay, what is the decent price for you to actually buy over this 7-Eleven? Right, so for Sam is 1 million. Any higher bidder or any lower bidder? Anyone else? Irene, 800K. Okay, good. We have 1 million, we have 800K. David, 500K. And what about the rest? So 1 mil, 800K, 500K. No more? Final. Anybody else? 3, 2, 1. Bid close. Okay, so congratulations to Sam Fong. Sam Fong, yes, $1 million. All right, so over here, I have 3 different answers for all of you. Number 1 is $1 million. So if let's say today, I'm like Sam, okay, invested $1 million. And every year I can get back 200K, right? So what is the return? 200K divided by 1 million, and that is 20% return every single year. If you look at my risk, how much am I going to risk? What is my maximum risk? My maximum risk is going to be 1 million. All right. But if let's say today I'm like David, okay, I only want to invest $500,000. So with 500,000 every year getting back 200,000, my yearly return is actually 40%. Wow, not bad, right? Okay, and because I only put in 500K, so my maximum risk in this particular case is only 500,000. And last but not least, if let's say today I'm very, not say stingy lah, let's say I'm a savvy investor, I only want to put 200,000. Okay, so 200,000 every year I get back 200,000, so my return is 100% in a year. Okay, what is my risk? My risk is only $200,000. Just by looking at this particular example, okay, it actually teaches us a very, very important lesson. Okay, and that is never listen to what the bank people tell you. Okay, just kidding lah, just kidding. Okay, why do I say that? Is because, right, okay, I believe that if you go to the bank, right, or if you go to any website lah, they always tell you that, you know, high risk comes with, can you just type in high risk come with what kind of return? High risk come with what return? Are y'all still here? I realize that a lot of people are stuck outside. Yeah. All right, high risk come with high return. Okay, yeah. Before I continue, I just want to apologize to those of you who are stuck outside. Okay, because I'm not managing the chat itself lah. So I apologize if you are stuck outside for 30 minutes. Okay. Anyway, I promise you that this particular video is actually on Facebook. It's on our Facebook group, Ultimate Investing as well. So you can actually get and rewatch it on the Facebook itself. So once again, apologize for the 20 of you who are stuck outside. Right, so you guys are right. Okay, so when you go to the bank, okay, people always tell you, you know, high risk come with high return. And of course, on the other hand, if you invest in something that is low risk, it comes with low return. So over here, I just want to share with you this particular concept. Like if you look at the one with the highest risk, $1 million, okay, 1 million is the highest risk. Does highest risk give you highest return? You realize not true, right? Okay, if you look at the one with the lowest risk, 200,000, does the lowest risk give you the lowest return? Also not true, right? So in this particular example that I just shared with you, can you share with me what is the concept over here? What is the concept over here? What kind of risk will give you what kind of return? Can you just type in? What kind of risk will give you what kind of return? High return. Okay, yes, fantastic. Okay, Alex got the correct answer. Okay, and that is low risk, high return. Okay, low risk, high return. All right, in this particular case, you look at one with the lowest risk, $200,000, but you realize that the return is actually the highest. Okay, the return can be actually the highest. So why is this happening? Okay, why is this thing happening, right? It's because you realize in this particular example over here, the earnings is something that is fixed. Okay, the 200,000 is something that is actually based on track record lah. Okay, 200,000 making every single year. But what is fluctuative in this particular example? Okay, what is fluctuative is actually the price. Okay, the price over here you can see from 200,000 to $1 million. That is a price that is just fluctuating. If everybody is very bullish right now, let's say now the market is bullish lah. So this 7-Eleven will definitely be worth $1 million. All right. But during a financial crisis, or rather when everybody is very, very scared, nobody dare to invest in the stock market. But if you know that this particular business, is making $200,000 irregardless whether got crisis or no crisis. Okay. And because everybody is so fearful, you get to buy this particular business at $200,000. Is it a good deal or is it a bad deal? Can you just type in good deal or bad deal? Exactly right. This is actually a fantastic deal. All right. So this is basically what value investing is all about. So we need to know what is the value of this particular business. And basically what we want to do is we want to buy it under value. Okay. We want to buy it at less than, let's say we look at this business lah. The fair value we say is 500,000. So as long as it is less than $500,000, it is basically a good deal. Okay. And of course, like I said, at $200,000, it doesn't happen every single day. In order for you to buy at $200,000, first of all, you need to know how to determine the fair value, or rather, what is the earnings of this company. So maybe some people say that, oh, this is just a 7-Eleven. But if let's say today you can ask the boss lah, the boss tell you that this is making $200,000. That is how you determine All right, whether 200,000, is it a good value or is it a bad value? Right, and using this particular example, I just want to share with you this particular method called the PE ratio, okay, price earnings ratio. So what is PE ratio? Basically, okay, if you look at the two words, price PE is basically price divided by earnings. Okay, price divided by earnings. So PE ratio basically will tell you the number of years for the investment to actually break even. So if you look at the example earlier on, okay, if you look at the example earlier on, okay, if you actually invested 1 million and every year you get 20% or 200,000, how many years does it take for you to make back your capital? You realize that it's actually 5 years. All right, if you look at the PE ratio, how do I calculate? I take the price, 1 million, divided by the earnings, which is 200,000. That give me 5 lah. So based on the second one, you give me the PE ratio of 2.5, and of course the last one give me a PE ratio of 1. 1 year I break even. So which one is better? You realize that 1 is better. So the smaller the number, the better it is. All right, the smaller the number, the better it is. Right, so if we use this particular example, right, to look at business itself, so we have Amazon, Alibaba, Disney, and Facebook lah. Let's start off with the first one, Amazon. Okay, make a guess. What do you think is the PE ratio of Amazon? If today you invest in Amazon, based on the earnings, how long do you think it will take for you to break even and make back your money? I make a guess, make a guess. Just put in any number that you feel that is belongs to Amazon. Okay, 50. Anyone? Let's have just a few of you. Okay, 50, 80. All right, interesting. And 150 and 90. Okay, so different people again is giving you different answer, but the correct answer is actually 90. All right, so a little bit crazy, right? So some of you will be, huh? So today, if I invest in Amazon, means 90 years later, then I get back my money based on the earnings. The answer is yes. Okay, so it's really 90 years. Okay, if you look at Alibaba, Alibaba is 42 years, Disney is 76 years, and Facebook is 31 years. So I know that some of you is like, so is this overvalue or is this undervalue? All right, so I'm going to tell you the correct answer, or rather the benchmark, later on. All right, but you realize that US company tends to be a little bit high in terms of the PE, tends to be like quite double digit, and of course the minimum over here is, you can see, 30. All right, and of course the most expensive is Amazon. And if you look at the local stock, Singtel, okay, make a guess, Singtel. What do you think is the PE ratio? Singtel. Anyone? Make a guess for Singtel. 20, okay. Any other guess? What is the PE ratio of Singtel? 13, 25, 15. Okay, good. Okay, at least I see the number tends to be a little bit smaller, but quite close. 22.67. Okay, once again, this is not the latest. This is based on 2 weeks ago. So yeah, but I would say that the price has actually went up. So I believe right now the PE ratio is a little bit on the higher side. Maybe 23, 24. Right, Genting Singapore is 16.59. Vicom 17.53, and OCBC Bank is at 10.12 based on 2 weeks ago. Once again, it's based on 2 weeks ago, right? So, okay, let's just look at this. So if today, let's just compare these two companies, Singtel versus OCBC, based on earnings, based on PE ratio, which one do you think is more undervalued? Singtel versus OCBC, which one is more undervalued? That means if you invest in Singtel, it will take 22 years for you to make back your capital, break even. If you invest in OCBC, every year you get about 10%. So 10 years you get back your capital. All right, pretty much I would say that everybody agree, right? OCBC is actually a better choice over here. Right, so what is the rule of thumb over here? This is the important part. Okay, for moderate risk investor, I would say that the PE ratio below 15 is what I call undervalue. All right, so anything that is below 15 is undervalued. Anything above 15 is overvalued. So coming back to my example earlier on. So pretty much based on these 4 companies, right, only one of them is undervalued. Okay, and that is OCBC. And if you look at the US company, okay, 90, 42, 76, 31. So some of you will say that, wow, that means US company cannot buy. Everything is overvalued. Answer is yes. Okay, most of the US company tend to be on a higher valuation because why? Everybody is investing in it lah. So the P ratio tend to be a little bit higher. And that is why for us today, I'm going to share with you another method to look at the PE ratio itself. All right. And that is for growth company. Okay, for growth company, we actually use this particular method called PEG. Okay, PEG. Yeah. So this one might be relatively new to quite a number of you. So PEG is got to be less than 2. What do I mean by this? Let's look at this company called Facebook. So assuming that, okay, Facebook has a projected growth rate of 22% every single year. It means we are expecting the earnings of Facebook to grow every year by 22%. All right. So PEG is basically, if you look at the formula, right, it's basically PE divided by growth. G is actually the growth rate of the earnings. So which means that I take the PE of Facebook 36 divided by 22, which is the growth rate. If this number is less than 2, that means this company is undervalued. Okay, growth in terms of profit, okay, earnings per share lah, earnings per share. All right. So again, okay, what is the difficult part about this particular portion is that nobody will actually tell you what is the growth rate of this company. Okay, so of course there will be certain website that will give you some guideline, but you realize that this number is something that you have to determine on your own. Okay, you have to determine on your own. There is no like this company is growth rate at 15%, this company growth rate at 17% or 22%. All right, so you have to kind of understand, okay, this business and look at the growth 3 to 5 years down the road. How fast do you think they can continue to grow and sustain this particular growth? So for example, for Facebook itself, just by looking at the P ratio, it is overvalued because it is above 15. But if I actually use this particular method that is used for growth company, all right, you realize that Facebook is actually undervalued. Okay, undervalued. Right, so this is just for the earnings itself. Okay, so you realize that today's topic is a little bit heavier. All right, the second one is actually on asset company. This is a lot easier. So how much would you actually pay for this box? So for example, if let's say I have this empty box, right, or rather just this mystery box lah. So again, people will give me $10, $15, $20, $100, $1,000. Everybody give me different price. But if let's say I tell you that, hey, inside this particular box, it has a Singapore dollar $1,000. So now, how much are you willing to pay for this particular box? Okay, the answer is very simple. Most of us, we want to buy below $1,000 or we want to pay below $1,000. Right? So that's the whole idea of this particular method called, okay, buying below book value. So first of all, you realize that, okay, in order for you to use this particular method, first you need to know what is the book value of the business itself. All right, what is the book value of the business itself? Or rather, when we use the word book value, it also means what is the net worth of this particular business. So usually we will use this particular method, right, on companies that has got a lot of asset lah, because it makes sense. So usually, right, okay, how do you determine what is the net worth of the business? For example, if you look at a human, or you look at a gentleman, how do you calculate the net worth of the gentleman? You take the asset minus away the liability. All right, the asset minus away the liability. All right. So if you look at a company, for example, like Facebook, do you think Facebook has got a lot of assets or not? Okay. Of course, Facebook has got a lot of cash and that itself has got a lot of asset. But if you look at the business itself, if you look at the building itself, most of the asset of Facebook is actually human resource. It's basically just computer, laptop, tables, and chair. All right. And of course, right now they have office lah. All right. So the business model itself is not exactly an asset-based model, right? So if we compare this to, for example, the bank, okay, the bank is basically full of cash. All right. So how do I know whether this bank is good or not? I look at the net worth of this company. So if this bank has got the overall net worth of 10 billion, I want to pay less than 10 billion to own this particular bank, and that is undervalued. So if you look at banks, developers, insurance company, or finance company, okay, we usually tend to use this particular method of looking at the book value, okay, and we want to buy below book value. Okay, we want to buy below book value. So for example, over here, all right, we have this particular company called OCBC. So how do you know the book value of OCBC? You go to Morningstar. So Morningstar, you'll be able to find this particular word called valuation, and you can see this term called price to book. Okay, price to book. So basically what we want to do over here is that, for example, okay, OCBC is worth $1 billion. Let's say the net worth is 1 billion. So if you are buying OCBC at $1 billion exactly, you are actually paying a price to book of 1, right? So what we want to do is, like I said, we want to pay less than 1 billion. So the answer that we are looking out for is basically we are looking for price to book at 0.8 or less. That means we want to buy 20% below the net worth of the company, or below the book value of the company itself. All right, 20% below the book value. So if you look at the 3 banks over here, OCBC, DBS, and UOB, starting with the first one, OCBC has got a price to book of 0.92, DBS 1.18, and UOB is 0.95. Right? So based on the asset-based valuation method, okay, the most undervalued banks so far is OCBC. Okay, the most undervalued one is actually OCBC. Apply to REIT as well. Yes and no. Okay, technically yes lah. Okay, but usually for REIT, right, I like to use the last method, which I am going to go through just in a while. All right. So different business, you can actually use different method lah. So for example, just now we look at OCBC, right? Based on earnings method, OCBC is already undervalued. All right. So if let's say today you want to invest in OCBC and you feel that this is an earnings company, based on the P ratio just now of 10, you can already invest in OCBC. So once again, like I said, a company doesn't have to fulfill all the criteria. It doesn't have to fulfill the earnings, the asset base, or the dividend. Okay, as long as one of them is fulfilled, you can invest in it. Okay, so for example, OCBC just now already PE 10, means that already undervalued, right? Means you can invest already. Okay, so this is another method for you to actually look at it. All right, this is another method from the asset point of view. And the last one is we want to look at companies with a lot of dividend, or companies that have been giving you a lot of dividends. So I think a lot of us, especially if you're investing in Singapore, you will love to actually look at this particular method more lah. So dividend company. So think of dividend as actually like your pocket money lah. Okay, do you want to receive intermittent or do you want to receive consistent pocket money? Can you all type in? Do you want to receive intermittent or consistent? Intermittent means on and off lah. Consistent means that every single month the pocket money is there. Okay, I think answer is obvious. Everybody loves to collect consistent pocket money. Okay, so the second question is, do you want your pocket money to decrease, increase, or stay the same over the years? Can you just type in the answer? Decrease, increase, or stay the same? Yes, you guys are right. So the first one is consistent. The second one is preferably increase over the years. So that's exactly the same when we look at the dividend company. Okay, so we don't just say that, hey, this company is giving me dividend this year. Okay, I think this is a good company. I want to invest in it. Okay, not that simple. So for example, I'm going to give you a case study over here. If we look at this particular company from the left to the right, okay, from the left to the right, you can see 2013 all the way to this word called TTM. Okay, to TTM. So dividend per share, that means how much dividend they are actually giving you. So can you see that this company, the dividend per share is actually increasing? So do you think this company, in terms of the dividend payout, is it good or bad? Can you just type in good or bad? From the left to the right, you can see 2013 to 2019. Okay, this is good, right? Okay, the dividend per share is increasing. That means your pocket money is increasing, and every year they are giving out. Means that every year is very consistent. So this company is what is called 3M. Okay, I'm sure you are familiar with it, 3M. The Scotch tape and all that is also under 3M. Very, very consistent dividend company. Second company over here, same thing from the left to the right. Okay, you can see the dividend per share 0.46, 0.25, 0.06, 0.05, 0.03, 0.01. I don't know what's going to happen next now. Good or bad? My favorite 3M, yeah. Okay, this is bad, huh? Okay, and anybody want to make a guess? What company is this? This is a Singapore company. If I never remember wrongly, this okay. Let me release that in case I remember wrongly. Okay, but yes, this is a Singapore company. This is Hong Kong-based company lah, but listed in Singapore. Hutchison Port Holding Trust. Okay, Hutchison HPH Trust. So if you look at what I've just shared with you, okay, you realize that hey, this is a lousy dividend company. But okay, I want to point out to you a trap over here. A trap. This is what I call a trap. Look at the dividend yield. Look at the dividend yield. 7%, 7%, 10%, 10%, 6%. All right. So if let's say today you are new to investing, you look at this dividend yield, people tell you, hey, invest in Hutchison Port because they are giving you 10%. Good or not? Good, right? It seems good. It seems like it's a good investment, right? Okay. I mean, today you invest in it, then they give you 10%. All right. But you realize the trend over here is that the dividend per share is actually dropping year over year. Okay, year over year. All right. And I think like what Simon has mentioned recently, Cheong. Okay. If you actually look at, okay, let me just share with you a very, very interesting one. Let me just pause over here. I think it's good for us to pause over here. Hutchison Port Holding NS8U. Let me just share the, okay, let me just share over here. NS8U share price. All right, so so Simon mentioned, oh, recently Chong, well, actually not bad, from 20 cent jump to 215. Okay, 1 month, wow, also not bad, from 18 cent jump to 22 cent. 6 months, wow, even better, wow, almost 100%. But let me share with you the overall trend of this particular company. Okay, just now my statistic is actually based on 2013. Okay, 2013. So can you see, this company, right, from 2013, what happened to the share price? From $1, okay, like 83 cents to 70 cents to 60 cents to 50 cents to 40 cents to 30 cents to 20 cents to finally 10 cents. All right. So you realize that there's a trend, right? Okay. And this is actually very in line with the dividend payout, because why? The company is making less and less money. Okay. And they can't actually afford to pay you dividend. So when you know that the dividend is getting lesser and lesser, right? Something is wrong with the company. So if we look at this particular company, NS8U Morningstar, let's look at the earnings of this particular company. How much money are they making on a year-to-year basis? All right, so you can just follow me on where I click lah. But again, if I click too fast, don't worry. You can actually go to our Facebook and rewatch it again. All right, and of course, I've gone through this on the series 1 itself already. So if we look at Hutchison Port Holding, let's look at the earnings per share. Okay, earnings per share over here. All right, from the left to the right, this company used to be making 0.34, okay, Hong Kong dollars per share lah. Then after that, you can see that since 2003, it has been dropping. Okay, then at one point, it is losing money. Then 0.2, 0.2, 0.11, negative 1.33, 0.06. So from a business perspective, this company is actually going downhill. Okay, it is actually going downhill, right? And if you look at the dividend payout, as what I've mentioned earlier, even though they are still giving you dividend, but you realize over here is that, can you see this payout ratio? This company is giving out a payout ratio of 197%. What does it mean? Okay, very simple. You can see over here, the company makes 0.19 earnings per share. They make 0.19, but dividend, they pay out 0.46. So just think as it from a human perspective. Today, you make $20,000 a year. Let's say you make $5,000 a month. Okay, and then you give out $20,000 a month. Maybe you have a lot of money inside the bank, but do you think this is sustainable or not? Okay, not sustainable. So as a result, what happened? The share price keep dropping and dropping. So of course, at one point, the share price might rebound, but fundamentally, you know that this company, right, unless the business fundamental change or they actually manage to turn around the business, okay, other than that, right, I will try to stay away, especially if you're looking at dividend. This is definitely not a dividend company for you to invest in it. All right, so these are some of the things to take note. So sometimes looking at the trend is important. Okay, tells you a lot of information. And of course, the last company over here that I just want to share with you, you can see that the dividend per share is pretty consistent, and then it start to drop quite a fair bit. All right, so what company is this? If you can make a guess, this is a Singapore company, is one of the blue chip and is in the telco business. Quite obvious lah, quite obvious lah. All right, telco business, Singapore company. Singtel, okay, not so bad lah. This is actually StarHub. Okay, Singtel is actually still okay. Yep, StarHub. Right. So same thing over here. Some of you might say that, you know, especially during this particular year, you see, wow, 2016, not bad, lady. This telco giving me 7%, 6%, even over here 9%. But after that, what happened? It is not sustainable. Okay. And immediately you can see what happened now when a company is, in fact, before even this particular year, before this year, okay, on the left-hand side, the company earnings is really dropping already. So you can really see that the company is making less and less money. You know that they can't continue to pay out this particular number. So what happened on this particular year, they immediately dropped by almost more than 50% in terms of the dividend. So can you imagine, right? If let's say today you depend on this StarHub for pocket money, let's say every month you collect $500, $500, suddenly, right, they cut your pocket money by half. From 500, they only give you $200. How will you feel? Okay. Probably not so good, right? Especially if let's say you are retired, you are depending on the dividend for your pocket money, then your pocket money gets cut. Okay, once again, it is not exactly the best kind of experience that we want. So always make sure invest in dividend. Look for the track record. Okay, go for a company that, you know, has been giving you dividend every single year and preferably increasing over the years. All right. Is this more on Singapore company? Not exactly. But I would say that if you're looking at dividend, we tend to use more dividend on Singapore company because there's a lot of Singapore company that give out dividend. Plus, Singapore dividend is non-taxable. Okay, non-taxable. If you're investing in US, dividend is actually taxable 30%. All right, US dividend is taxed 30%. But if you're investing in Singapore, dividend is non-taxable. Right, so what is the key over here when it comes to investing in dividend company? Look for consistent and growing dividends with the dividend yield of more than 5%. Okay, more than 5%. All right, I think this is something that is very, very important now. Okay, so if the dividend is too low, okay, doesn't make sense for you to invest in it. Just put your money inside the bank. All right, so what is a decent amount? Okay, what is a decent dividend yield that we will be looking out for is actually 5%. I think at one point, okay, OCBC was actually giving up almost at about 5% if I never remember wrongly, right? So again, at the point of time, if you are looking at the dividend from a dividend perspective, wow, OCBC is actually a very good deal, okay, because you know that fundamentally the business is stable enough to pay out dividend every single year. Right, and of course, this year the government actually asked them to cut the dividend. So that one is the government fault not the bank fault Okay, but pretty much I would say that the banks, in terms of the fundamental, the financial, they are actually still doing quite well, especially the 3 local banks in Singapore. Right, so now it's the time for us to do some shopping. Okay, do some shopping. Right, so what happened is that, okay, we are going to go into our fundamental investing shopping list. Okay, and what we want to do over here is that I actually need your help. So today, we probably are not going to look for new company, but we are going to, based on the existing company, we are going to go through the valuation, okay, the price to earnings, the price to book, as well as the dividend yield. So I just need you guys to actually help me to look out for all this information. All right. So can I just check how many of you are ready to help me to do some work over here? If you are ready, can you just type in 555? All right, but as usual, for those of you who help me to do some work, you will be rewarded. Okay, you will be rewarded. What is the reward? Later on, I will share. But if you want to help me, just type in 555 while I prepare the spreadsheet. Okay, while I go and prepare the spreadsheet. Okay, fantastic. Wow, I have a lot of people who are willing to actually help me to look at the list itself. So great. Thank you so much for offering. Right. So of course, like I said, today I just want to benefit all of you. So let me just share my screen first. Right. So this is actually, let me just take a look. Okay. Yeah, maybe we will use this instead. Okay, let's use this instead. So this is actually the list that we have actually done on the 13th of December. Okay, about a month ago for our series 1. Okay, thanks to all of you for actually putting the hard work. We have a list of 20 companies with the 4 fundamental: earnings per share, operating cash flow, ROE, as well as debt. So we have the scoring over here. So for today, we are going to focus on these 3: PE ratio, price to book, as well as the dividend yield. All right, so we are going to look at many of all these companies, okay? Singtel, Palantir, C Limited, Alibaba, Google, Visa, and of course, we have some Singapore company as well. So I'm going to show you one time where to get all this information. Later on, I'm going to allocate the names to all of this, and then you are going to help me to go and look for the answer. Okay, and then we're going to combine everything together. And by the end of, maybe you're going to extend about 10 minutes. So about 10:10, we are going to walk away with a full list, okay, by the end of this session. Right, so for example, I'm going to use Singtel as an example. How can I get all this information? So step number 1, okay, if you are the one that is willing to help me to do work, you have to listen up very carefully. Go to Google and type in Singtel space Morningstar. Okay, Singtel space Morningstar. And once you have typed in Singtel space Morningstar, click on the first one on the search engine. All right, and subsequently, once you come to the main page, I need you guys to click on the center. Over here, we have this thing called key. Once you come to the main page, okay, shortcut, you can actually just click on this one, valuation. Okay, valuation. I'll show you the full method lah. Okay, so can you see over here? Once you click on valuation, you will be able to find the price earnings. Just give me the current one. Okay, in the case of Singtel, is 24.14. And next, we also want to look at the price to book. Okay, the price to book. So can I check? Price to book is over here, 1.5. So this is the two things that I'll need, 24.14 as well as 1.5. And then the earnings yield is basically the dividend. Hey, is it? Let me just double check. Let me just do a quick check. Over here, there's a dividend. Okay, I think let's be safe. Let's use the dividend over here. So over here, the dividend, same thing, based on the total yield on the current one, give me 4.34. So these are the 3 information I'll need for all the companies that we are going to go through together. So I repeat again, under dividends, total yield, current year. All right, and for the rest, under valuation, price to earnings, and price to book, okay, under the current year. So these are the numbers that I will be required from those of you who are willing to help me to do the work. All right, so I'm going to allocate your name to the company. So I need you guys to help me to listen up carefully. So for Karim, okay, please help me to do Singtel. And then for Irene, can you help me to do Palantir? And for Dwayne, can you help me to do C Limited? For Yusuf, can you help me to do Alibaba? And for Lau is Google. Okay, K Gi Ku, can you help me to do Visa? And Jared, can you help me to do PayPal? And AL, can you help me to do AAPL? And Lucinda, can you help me with Microsoft? Okay, Simon, can you help me with Corsair? And Calvin, can you help me with DBS? And David, UOB. Marvin with Thai Beverage. And Alex with CrowdStrike. Okay, Alex with CrowdStrike. And Jay with Capital Land. I need 4 more volunteer to help me with the last 4. All right, so never mind, I'll just stick to this list first. Okay, then if we have more volunteer, or for those of you who have already finished it, you can also give me the rest of the number as well. So we're gonna think about maybe about the next 10 minutes, right? Okay, you're gonna do the research lah. Of course, for those of you who are not doing the research, then you can just follow me while I actually key in some of the information. So once you have this information, okay, please pass it to me in this particular sequence: PE ratio, price to book, dividend yield. So you can just put a bracket, okay? For example, just type in the group chat 21.04 space 6.12 space 3.35 with the stock name, so that I know which stock it belongs to. Right, I'm going to put your name again over here. So just so for you all to know, okay, which one that you are required to help out with. Okay, and yeah. Name space morning star, morning star. Oh. All right, so for Jared, okay, Jared is fast, PayPal 91.49. Okay, price to book is 15.37 and dividend yield is 0.54. Okay, for Marvin is Karim is P 24.14. Price to book 1.5. Okay. All right, just keep it coming. Just keep it coming. I will try my best to type in as fast as I can. Yeah, so for the rest of us, we will just hang on, and once the list is completed, then you guys can actually take a screenshot so that everybody can actually benefit from it. Okay, 1.5, great. And for Dwayne is PE not stated. Okay, 145.15. Okay, and dash. Great Eastern. Okay, let me find Great Eastern. Great Eastern is, where is Great Eastern? Wow. Okay, Great Eastern is 11.49, 1.11, and dividend 3%. CrowdStrike is dash 60.85 and dash. Capital 15.22, 9.06, and 0.8. Oh, that's Corsair. Okay, I think I got the wrong one. Corsair is 53.2, 9.06, and no dividend. Oh. Capital Land is 13.22, 0.69, and 3.52. Okay. DBD. How come somebody? Oh, DBS. Okay. DBS is 14.9, 1.29, and 4.39. Oh, okay. Yeah. So DBS dividend yield is quite decent. All right. 4%. So 34.77, 5.71, and 2.41. All right. Apple. Where's Apple? AAPL. Okay. 40.26, 34 and 3.83. All right, and Microsoft. Okay, Singtel already done. Eh? No, Singtel is dividend yield is higher, 4.29. 4.29. All right, prompt next. 9.6, 3.72, and 3.87. And the Microsoft is 35.42, 13.46, 2.36. Tesla. Oh, okay. Yep, somebody have done Tesla. So PE 1,673.04. Wow. All right, interesting. All right, and of course, no dividend. Yep. So amend DBS. Okay, DBS amend 14.9, 1.29, and 4.39. Yep, correct. I already amended. Please correct Singtel dividend to 4.29. Yep, done it. Alibaba. All right, I'm not done yet. Right, 6.96. Price to book is 4.72 and no dividend. And Visa. Visa is over here. Right, Visa is 44.09, 15.27, and 0.61. All right, I think that's a correction. All right, we are just a few more to go. Okay, Thai beverage, just give me a moment. Thai beverage is 18.73. And later on, I'm going to go through some of the very, very important one to share with all of you. Some I think is quite interesting. So there's actually a few learning points that we can actually get from this particular exercise as well. All right. And dividend is 0.24. Yes, okay. Sorry, dividend yield should be 2.55. For Marvin, Marvin is Thai beverage, right? Thai beverage dividend yield is 2.55. Thai beverage, where are you? 2.55. All right, mistake Alibaba is PE 31.04. Okay, did anybody is doing a C limited, or can you all help me to repost? All right, if I miss it, C limited as well as UOB. Can you help me to repost it? I'm not sure if I missed it. UOB as well as C limited. Okay, I saw C limited. PE is not stated. Yeah, I thought I did C limited. Okay, let me just 145. Oh, okay. So I key in the wrong one. So Palantir, I didn't get Palantir. Okay, yeah, Palantir. I think I got the wrong one. Right. Do we have Palantir as well as UOB? Palantir and UOB. Okay, yep. Okay, so anyway, okay, maybe for this two, I will just go through one more time, okay, for those of you who didn't manage to actually do it, okay, so at least I will go through Palantir as well as for UOB so that you actually get to know how we actually look for all these answers. So first of all, okay, very simple, go to Google, type in the name, stock name, Palantir space Morningstar. All right, once you come to the website itself, click on the first search and then click on valuation. Yes, thank you so much, Jared. Yeah, don't worry, let me just run through. Yep, so for the valuation under P ratio, you can see is dash. So the first one is a dash. And coming back to the price to book, it is 37.81. Okay, 37.81. So 37.81. And yeah, pretty much, I think without even looking at it, I know the dividend yield is dash. Okay, and of course, UOB, let's go through UOB once again. So same thing, go to Google, type in UOB space Morningstar. Click on the first search, click on valuation. Right, so after you come to valuation, under the current, look for PE ratio 11.29 and the price to book is 1.01. So 11.29, 1.0. Okay, let me just go through 11.29, 1.01. And the dividend yield is, click on dividend. We get a dividend yield of 3.93. Okay, 3.93. 3.93. All right, I hope I didn't miss out any of them, any of this. Okay. Yep. So anyway, all this should be in percentage, okay, 4%, 2.41%. Let me just run through some of these companies so that I just want to share with you all some interesting facts over here. So for example, if we look at, let's look at, for example, Palantir. Okay, maybe you choose a one that is more familiar. Let's look at Tesla. Okay, Tesla. Where's Tesla? Right, so if you look at this particular, so Tesla, if you look at the four fundamental, okay, earnings per share fail, operating cash flow fail, efficiency fail, debt fail. If you look at the price earning, 1,673, which means that if you invest in Tesla today, okay, based on the earnings, it is going to take you 1,600 years for you to make back your capital. All right. So yeah, this one is definitely a fail. And if you look at the price to book, right, it's actually giving a 52.03, and that is very, very expensive. Okay. Remember, our price to book, we are looking at 0.8 or less. All right. So why is it, wait, before, let me just touch on first. But why is it that, right? Okay. I just want to touch on the, okay, let's go to Google and we search Tesla share price. Okay, this is something that I just want to share with all of you. Right, if you look at just this year alone, okay, in fact, earlier this year, the price is only $183. It went all the way up, and right now it is at $880. So how come, okay, how come everything failed? Valuation very, very, very expensive, but yet the share price keep going higher and higher. All right. So if you want to know the answer to this, right, okay, please join me 2 weeks later for our Fundamental Investing Series 3, whereby I'm going to share with you, companies like this, whereby if you look at the numbers itself, right, it doesn't make sense. Another company is, of course, I can share with you is C Limited. All right, C Limited. Let's look at C Limited. You can see, earnings per share passed, but everything fail. They are currently losing money, so P ratio is definitely a negative, is dash, right? And price to book is super expensive. They're not giving dividend. But once again, okay, let's take a look at C share price. Let's look at this. Can you see just looking at the last 1 year of this company? Okay, this is the company that Shopee okay, you're familiar with Shopee, maybe not familiar with C, but yeah. Early this year, it is only $50. Then it went up, $60, $70, $150, $100. Now it's $100, $200. Okay, again, why is it that this company, right, is it defying gravity? Everything seems to be so lousy, not making money. Still, the share price goes up, right? So remember, just now we talked about boyfriend 1, boyfriend 2, and boyfriend A, B, and C. This is the kind that belongs to boyfriend A. All right. That means right now, on paper, everything looks lousy, but they have the potential to make a lot of money in the future. Okay, they have the potential, right? So these are kind of company, right? Like I said, it is not easy for you to determine, because why? Okay, you need to do a lot of research, and of course, there is a lot of future projection that you actually have to make, okay, in order for you to invest, right? So I do actually share that this group of company, if you are able to pick them, you can actually make a lot of money, okay? But yet at the same time, in terms of the valuation, okay, because there's no way you can actually evaluate. Like for example, if I talk about a Harvard student, right, how much is it worth? Some people say that they are worth 1 million. Some people say that they are worth 10 million. Some people look at the full value. They say, well, this Harvard student maybe next time become billionaire. I think this student is worth $1 billion, right? Again, you can see that because there is no real fundamental over there, okay, and that is why the share price can just go as high as possible. All right, and that is why you can see, for example, Tesla with a price earning of 1,673. Right. So this kind of company, right, usually we can't just depend alone on the facts itself. We have to also look at the technical chart, okay, to determine whether to look at it or not. But pretty much just by looking at it, right, so far I didn't see any dividend yield that is above 5%, okay. but I do see some that is pretty close. So for example, DBS is at 4.39. So I believe that a couple of months ago when the price is relatively lower, the dividend yield of DBS was actually more than 5%, which means that at a point of time, you could have picked up dividend, you could have picked up DBS based on the dividend yield being more than 5%. Okay, that means at the point of time, it was undervalued. At this current point of time, okay, let's look at DBS. Okay, PE ratio, like I said, is the good one is below 15%. So technically, okay, I would say that if you look at DBS based on PE ratio, it is currently slightly undervalued. Okay, it is currently slightly undervalued. Okay, so same thing for UOB, and I believe for OCBC is the same. So I do see that for the three current banks, just looking at the PE ratio, all three local banks are still relatively undervalued. So I think Singapore, these three banks is something that I'm actually more bullish on, right? And Propnex is also a company that I have shared in my buy or buy series, I think quite a couple of months ago. And based on some of the students, they actually mentioned that the share price actually went up quite significantly. But even based on current, if you look at P ratio of Propnex, it is still undervalued, and it is also giving you a dividend yield of 3.81%, which is not bad lah. Okay, so I would say Propnex is also something that caught my eye over here. Other than that, okay, let me just do a quick run through. CapitaLand, okay, CapitaLand, okay, the price to book is actually based 0.69, okay, which again could be of value because it's below 0.8 lah. All right. But of course, like I said, we have to run through the full numbers again before I can give the final conclusion. But again, this is a very, very quick guideline on how you can determine whether is it a good company and also is it undervalued or not. All right. So I hope today has been a great learning lesson for all of you. All right. And of course, I know some of you would have some burning questions that you have that you want to be answered. All right. So what happened is that if you have any questions, okay, do actually drop us a message on Facebook at Ultimate Investing, and we will be happy to actually answer your question. And of course, before I end off, okay, let me just have share with you one final news over here. All right. So yeah, again, for those of you who have actually helped us with the Seedly review, okay, do go and collect your books lah, and also do go and enjoy your food and drinks over here at Doubler, guys. And of course, for the rest of you, if you like what we have been sharing with you so far, okay, and of course, 2 weeks later, like I said, I'll be sharing with you more in depth, okay, on how you can actually pick companies that belongs to the boyfriend A. That means the potential kind lah. Okay, the potential kind. Okay, do join us 2 weeks later. And if you like what we have been sharing, do leave us a review on bit.ly/seedlygifts. And yeah, after you have done it, okay, just reward for you guys. You will also be able to receive the physical book. Okay, and you have to collect on your own. All right. With that, okay, maybe I'll just stay on for about 5 minutes for Q&A. So if you have any questions, okay, do stay on. If you do not have any questions, okay, if not, that's all from me. I just wish you guys, have a great weekend. Okay, yeah, today is what day? Let me just do a quick check. Today is Sunday. Okay, sorry. Yeah, I hope you have a great week ahead. Okay, very importantly, stay safe, invest safe. All right, and keep yourself warm during this very, very cooling, January period. All right, with that, I'm going to take on 5 minutes for Q&A. And if you have any questions, please do type it into the group chat, and I'll be here to answer your question. Right, if not, then thanks for sharing. For those of you no question, okay, you are free to leave. And good night, everyone. Thank you. And what is your Facebook page? Yeah, that is a good question. Okay, let me just go through. Right, so if you want to look for us, you want to drop us a message, go to your Facebook. Sorry, please search for this one, Ultimate Space Investing. All right, this particular logo, black color one, just go and follow us. And of course, if you have a message, you can just drop us a message somewhere over here lah. All right, and yes, let me just answer. I joined during the UI day, but never received anything on the online course. Okay, we should have send you the link to join us. All right, yeah, but let me check. Okay, for Simon, yeah, let me just do a quick check for your site. Yeah, maybe you can also just drop me drop and drop a message to this Facebook group so that we can have a record. Yep, and thanks for joining us on the UI day itself. If you have joined us for the program, yeah, congratulations, because right now still on promotion. Okay. Right. Anybody have any questions? Anyone have any questions? Any question? I'll be happy to take on any questions for the next few minutes. Can I have the spreadsheet? Okay. Wow. Very, very good question. Okay. Yes. All right. So for those of you who actually helped me, okay, sorry, I didn't announce lah, but anyway, for those of you who helped me with the spreadsheet earlier on, okay, I have all your names over here. I will be contacting you guys individually, and I'll be giving you access to the spreadsheet. So which means that every 2 weeks, okay, as long as I update the spreadsheet, you will get all the information. Okay, so you get full access to the spreadsheet. All right, so don't worry, I will connect those of you who actually helped me to contribute. For those of you who haven't get the spreadsheet, okay, join us 2 weeks later and help me to contribute lah. Then you get a chance to actually get the full access. All right, if not, let me just share the spreadsheet once again so that y'all can actually, I know some of you maybe haven't taken photo. Yeah, if you want to take a photo, you can take a photo if you have not done so. Yeah, those of you with the full access, you basically can get everything lah. Okay, so subsequent weeks, I will just update the list and you will continue to receive all these updated lists. All right, anyone have any question? I still see that we have 38 of you here, 38 of you. Lai. Okay, 37 now. Let's one more lesser. All right, anyone have any question? If there is no question, then I will disappear in a couple of minutes time. In the meantime, all right, I'm gonna play Jay Cho song. Yeah, so please don't fall asleep. Right, thanks everyone for joining tonight, and I think you can have a good night rest. Very, very cooling weather together with this nice music.